Canada's inflation rate easing to 1.6% in September, and that is the slowest pace since 2021. So, does it mean a 50 basis point rate cut could be in the cards next week for the Bank of Canada as they make their next decision? Joining us now to discuss is Robert Both, Senior Macro Strategist with TD Securities. Robert, great to have you on. You and I have had so many discussions over the past couple of years about the fight against inflation. We get a print this morning of 1.6% on headline. Break that down for me.
Thanks, Greg. As always, it's a pleasure to be back on the program. And I remember just last month when I was here how monumental it seemed that we were actually back to that 2% midpoint. After years above target inflation. So it is quite surprising now as we sit here today to be talking about inflation not just a little bit below the headline or below the midpoint of the Bank of Canada's target range, but actually down all the way at 1.6%. Now, we thought inflation was going to come in closer to 1.9. The market was at 1.8. So today's report was quite a bit softer than expected. But if you look at what drove that headline surprise, perhaps it's not as alarming as that 1.6 might imply. Now, the Bank of Canada's core inflation measures, which are designed to look through fluctuations like energy prices, like food and anything else that's moving rather sharply on a month-over-month basis, those were more or less in line with where the market thought they would be. The Bank of Canada looks at both a trimmed mean and a weighted median as a better idea of where inflation is trending. Together, those two are at about 2.35%. So even though headline inflation is below the Bank of Canada's midpoint, on a core inflation basis, we're not quite there yet. Now, obviously, for the last few years, we have been talking about too much inflation, and for Canadians who are very focused on the cost of living, and seeing real wages lag after a long period, seeing inflation come down to 1.6% is very positive news. But much like we don't want too much inflation, we don't want too little either. You want it to be really close to that 2% midpoint. So as we do start to drift below that target, that has started to increase the chatter about the potential for larger interest rate cuts in Canada. Now, we still think the Bank of Canada is going to do a quarter percentage point cut at next week's meeting. Others think there will be a larger rate cut, and I would say that today's inflation report has skewed the risks towards that larger rate cut. But with core inflation still running at about 2.3 to 2.4%, with growth showing signs of improvement into the last quarter of this year, we do think that the Bank of Canada can hold the line here and continue to ease at those quarter point increments.
Yeah, because heading into this inflation report, of course, the last piece of information we had before this one was that labor market report, the jobs, and much stronger report than expected. And the tone heading into the long weekend was like, well, if the Canadian labor market's holding up this well and surprising to the upside, then you don't need to cut by 50 basis points. Obviously, this inflation report right now, it sort of put some interesting factors into the mix. You said you're still in the 25 camp, but there's sort of a growing chorus out there saying like maybe it's 50.
Certainly. The Bank of Canada is not going to look at any one piece of data by itself. That's true whether it's an inflation report or something like last Friday's jobs report. But even if we just look through that headline number last Friday, we added 46,000 jobs on the month. That is very positive. Full-time employment was driving that. The 6-month trend is starting to improve as well. That was about 30,000, still not quite at those levels you need to maintain the unemployment rate, but that slack we're seeing build up in the labor market starting to build up a little more slowly, and that does speak to the growth picture looking a little better as we head into next year.
I found this report so interesting too, not only the fact that the headline number hits 1.6% lower than we're expecting. StatsCan took an opportunity to sort of pull back the lens and say, okay, we're obviously, below 2%, but think about where prices have moved in the past couple of years. The number they threw out that really caught my eye is that compared with September of 2021, so we dial back 3 years, CPI, inflation's up almost 13%. I mean, these are price gains. As inflation cools, it doesn't mean that prices are going down, it just means the rate of acceleration is cooling. People are still dealing with high prices in this economy.
Of course, and that's not going to change, if inflation's, 1.8, 1.6 or 2%. The Bank of Canada is targeting inflation. It's not targeting prices. So what that means is even though we have seen prices accelerate more quickly than the BOC has been expecting or targeting over the last few years, the Bank of Canada is not going to try to offset that going forward. So it's easier for Canadians' households, for businesses to plan if they do expect inflation to be 2%. If you were to look at other operating regimes like price level targeting, which is something the Bank of Canada started in their previous mandate renewals, what you tend to see there is that even though there is some benefit if for instance, bygones are not bygones, if they actually try to steer policy to account for those overshoots or undershoots, it does make planning a lot more difficult because for one, it introduces some uncertainty about just how long does the Bank of Canada have to get inflation to average 2% over the medium term, and two, do they actually have the conviction to make up for those previous undershoots by potentially holding policy a little tighter going forward. So yes, even though that's not going to necessarily make up for the high inflation we've seen over the last few years, we can be a little more comfortable that inflation is going to remain near this 2% level going forward.
Near the 2% level, are you anticipating as we go forward, we're not going to see 1.6 going lower and lower? The fact that, every month can be a bit of a gyration. Would you think that perhaps in the months going forward, as the base effects start to level out, we're closer to 2 and not so much drifting lower?
Right. We do expect to get back to that 2% as we get into 2025. As we go forward over the next few months, you are going to see some rather large base effects drop out of the year-over-year measurement. The energy price declines we saw towards the end of last year, we don't expect those to repeat themselves. That should give inflation a bit of a lift into year end. And we're also certainly expecting that persistence we've seen in shelter prices to continue going forward. So even though we did see a bit of a one-off drop in rent inflation this month, we do think that sticky shelter prices are going to remain with us into next year as well.
So next week's meeting, obviously going to be closely watched. We've been closely watching all of them. If you get the quarter point, as you're thinking, and they're going to take all this, balance it out, what kind of path are we on? Where do we end up? In the end, when this is all over and inflation is a distant memory and we're at 2% and the Bank of Canada's brought its rate down to where it feels it should be, where are we going to be at?
So I think, within that discussion of is the bank going to do 25 or are they going to do 50, there's another discussion there of, where do policy rates need to be in 6, 12, 18 months' time? Does the Bank of Canada still have conviction that we're on track for that soft landing? Are they growing more concerned that we could be on track to potentially undershoot the 2% target and therefore require more stimulative monetary policy? Traditionally, the Bank of Canada has not done 50 basis point cuts if they do expect to end at their neutral rate. If the Bank of Canada is growing more concerned about downside risks, about that inflation potentially getting stuck below 2%, then you're looking at a scenario where the bank might want to get into stimulative territory. So, that's a scenario where if the bank is cutting by 50 basis points, they want to get interest rates well below neutral and actually to bring inflation higher to target. We don't think we're on that path. We think they are going to continue cutting by 25 basis points per meeting, which should get us to neutral by the middle of next year. But if the Bank of Canada does become significantly more concerned with downside risks and they do see the need for that stimulative policy, that's when you could see 50 basis point cuts materialize and you could potentially see a terminal rate that is below the bank's estimated neutral rate.